Welcome to step number 6, where we're talking about DCF valuation. And so after this step, meaning in step 7, we'll look at other types of valuations like price earnings and price to revenue. And then we'll take an average of all 3 valuation methodologies to minimize the margin of error when we come up with our target price. Okay, and so this is a lot easier than you think. You've already done the hardest job, which was creating the model. So let's stick with the Tootsie Roll Corporation, which we created in step 2. We did the revenues. Remember, step 3, we created the income statement. Then we did the balance sheet, and then we did the cash flow statement in step 5. And if you forget how to use all that stuff, you can always click to watch the videos here, and that will just go directly to YouTube, which is the same video from within the course. Okay, great. Let me go back here. Here we go. Great. All right, DCF valuation. So these free cash flow numbers are brought in directly from the cash flow statement, right? They're green. So let's just check out where this is from. So I'm going to hit Command or Control, open square brackets to link. Okay, and I like to use the arrows back and forth because I get confused where I am. Bottom right hand corner there, you see? Okay, good. So this pulls the free cash flow from here. And remember from the previous exercise or the previous lessons, we learned that free cash flow is just operating cash flow here, right? Cash flow from operations minus CapEx. Okay, and we don't really have CapEx here with our Tootsie Roll company. That's fine. Okay, we'll keep it simplistic. Okay, great. So let's go back now to the DCF valuation, and we can click down here, same thing. Okay, great. So these are cash flows, and we know from our Spock $5 Canadian bill lecture that these cash flows have to be discounted into today's terms, okay? And let's just assume we're at January 1st, 2018 for simplicity. Okay, let's scroll down. So what is the cost of capital? Meaning, what are we going to discount these future cash flows at to get them into today's terms? Okay. Well, we know that our capital structure is 100% equity. We don't have any debt, right? And if we want, we can go back here to check if we actually have debt. Short-term debt, long-term debt. Nope, we don't. No debts. Okay, let's go back. Okay, it pulls it off there directly. So 100% of our capital structure is equity. If it was less, watch this. And because it's blue, I'm allowed to type on it. 50. What would happen is it'd be 50-50. Okay, you see that? Okay, let's go back to 100 though. Okay, great. So as is, you can see that the cost of capital is 14.5%. That seems kind of high, and I'm going to adjust that in a second. You'll see why. Okay. If we look here, we got the market cap today and the stock price today, and these are coming from other sheets. You can link them if you want to the income statement or to step 7. I like to link to step 7. I'll show you how. Okay, don't look at this, please, too closely. We're going to go over this in step 7. Okay, this is basically just 3 valuation methodologies, and then we're going to divide by 3 to get our target price. Okay, this is DCF, which is what we're doing right now. Okay, but I brought you here because I want to show you that we got the market cap here from this sheet, and we also got the current stock price here, and that's hard-coded. Okay, good. Let's go back. All right. So now we're still dealing with the weighted average cost of capital. Okay. So the cost of equity we've got right here. What's the risk-free rate? And as I mentioned in the previous lessons, we know that the risk-free rate is the government rate or the lowest risk rate you can find out there. Okay. And we can assume it's 2.5%. And please play around with these blue numbers to see what happens, right? So if you increase this, watch if I made this 5%, which wouldn't be the case, right? Then we got lower cost of equity there. Now the beta, this is what I want to change. This beta here, which defaults at 2, remember it's just hard-coded, it's blue. This beta here is too high because I don't think that the Tootsie Roll Corporation is twice as volatile as the index, meaning the S&P 500, for example. So I'm going to change that to, let's say, 1.5. And before I hit enter, I haven't entered yet. Watch what happens to the cost here of equity. Goes down. Makes sense, right? Because a Tootsie Roll company is not twice as volatile as S&P 500. Okay. It's 1.5 times. For example, if it was less volatile than the S&P, say 0.8, watch what happens to the cost of equity on the left when I hit enter. Goes down to 7%. That's a big deal. Okay, good. All right. Now, The stock market return, we're assuming it's 8.5% over time. You can put in your own assumptions. You can assume 15%, right? That sort of thing. Let's just keep it there, okay? Keep it simple. In this spreadsheet, at times can get a little bit complicated, so I'm going to show you something amazing. Okay, let's go to formulas, and you can trace dependence. So this cell here is dependent on this cell, right? And if I click trace precedence, nothing's going to come up, okay? You'll see why. Watch this. Nothing. Why? Because there's no precedence because this is blue. It's hard-coded, okay? Remove arrows, okay? Same thing here. If I click on trace precedence, nothing. It's hard-coded. But if I trace dependence, watch this. Isn't that cool? It feeds into there. Let me remove arrows. By the same token, if I click this, well, what goes into that? I can either look at the numbers or I can go trace precedence. Aha! There's 3 variables that are going to there. Okay, let me remove arrows, trace dependence. It goes up there. This cell, all this cell here does is it just goes down there and just does the math. Okay, great. So remove arrows. Play around with it though. And please, I'm encouraging you to change all these blue numbers here. This is how you learn finance. Play around with this, okay? And make your own assumptions as well. All right, let's talk about debt. Okay, so we don't have any debt in our capital structure, right? If you go to the balance sheet, you'll see that we have no debt. Okay, and so if we did though, and play around with these numbers here too, okay? The cost of debt, let's say it's 5% for a loan, right? And remember, we get that government incentive here, right? You get for 25% tax, right? Now watch this. If the cost of debt was 10, I'm not going to enter yet. Look at the 3.8 on the left there, okay? Obviously, we're going to pay more, right? So, or the cost of debt's going to go up. Now, don't do what I'm going to do, but I'm going to hard code over this green number here. Let's say the interest rate was, or pardon me, the tax rate was 40%. Watch what happens on the left, right? We get that benefit. Okay, great. Okay, let's scroll down here. Net present value, which was discussed in the previous lectures, but it's an amazing function in Excel. I just love this thing, okay? But because what it does is it basically says, all right, all of these cash flows, I'm going to discount into today's terms. That's January 1st, 2018. Assume that's where we're at today. I'm going to discount all that stuff using your WACC, meaning your interest rate or your discount rate. Same thing. Double click, right? And let's go through this. Where's the blue? Okay, good. So we're taking 11.5%. And then it's going to use that rate and it's going to discount these cash flows. I love Excel. It's so cool. Great. So now we know what the value is of all of these 5 years, okay? Cash flow, right? Watch this. If I highlight all of them, it gets 1,306. You see there in the bottom right-hand corner, okay? However, the net present value is lower. You know why? Because we have to discount it using this, okay? So if I hard-coded this to 1, watch what happens. I'm going to hit enter in a second. Watch what happens to the 922. It goes up a lot. Isn't that wild? We're only discounting at 1%. Okay. So let me hit Control Z and do that. What if I did 0? If I do 0, it's saying that the net present value is what those cash flows are going to be worth in the future, right? So look at that, right? And that's not realistic because you always have to assume a cost of capital. I can Control Z that. Okay, don't hard code like I did. Okay, great. So we got the net present value for those 5 years above. Okay, again, these 5 years, which are pulled again directly from the cash flow statement here, right? Which is again operating cash flow minus capex. Okay, we don't have any capex here. Let's go back here to step 6. Okay, great. So just look here. Don't look down below yet. So let's assume the long-term growth rate is 2, and I'm pulling it from here, right? And as I mentioned in the previous lectures, you can never have a long-term growth rate that's higher than just a couple percent, okay? It's impossible for a huge company to grow organically that much in the long run. Look at the U.S. economy. As I mentioned, GDP growth will never be more than a couple percent. It's not the U.S.'s fault. It's just a big economy. It is what it is, okay? Okay, so what does this mean, Chris? What is a terminal value? Well, the terminal value, as I discussed in previous lectures, is the value of all future years into infinity, Okay, and I'm not a big fan of DCF because your terminal value can be 95% of the value of the whole company. Okay, there's so many assumptions. So what's the value going to be for 2023, 24, 25, 26, 27, 28, yada, 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 all the way up to infinity for cash flow? Okay, that's called the terminal value, right? It's kind of a weird name, terminal. Okay, so basically, here's the formula, okay? The terminal value is equal to the last year's cash flow, this guy here, okay? Then we multiply it by 1 plus our long-term growth rate, okay? So that's that last year of cash flow here, times 1 plus the long-term growth rate, which is 2% in this hypothetical example, okay? Then we divide it by our WACC minus the long-term growth rate, okay? And we know that our WACC is here, okay? And that's the terminal value, meaning the value of the future cash flows from the years 2023 to infinity, okay? Now, once we get that, that will tell us what those future cash flows are worth right here. We got to discount that back to today, which let's assume is January 1st, 2018, okay? I'm going to hit escape to get out of this. All right, so how do we do that? So all we do is we're just going to discount it 4 years. This divided by 1 plus the interest rate or the discount rate or the WACC, same thing, to the power of 4. 4 years, okay? I'll show you. 1, 2, 3, 4. And you could say 5 if it was at a different point in time, whatever. Just assume 4 for now, okay? Just accept it. Thank you. Okay, cool. Great. So now we've got the value of all the future 5 cash flows, right? These dudes here. And we've also got the value of the terminal value, which means this dude to infinity, okay? Now, we've got to discount it as well. It's this value. So we can figure out the target value of the company and target price. Okay, before I go there, I want to show you something. Watch this. The terminal value is way bigger than the net present value, right? And I've seen cases where it's, a gazillion times bigger than that. Okay, and this is why I'm not a fan of DCF. Okay, there's so many independent variables. As I mentioned in previous lectures, if I tell you x plus 1 is 3, we know x equals 2. But if I tell you that x plus 1 plus p plus w plus q equals 6, what's x? Exactly, we just don't know. There's too many independent variables, okay? All right, so we've got our target equity value, right? And I can double click and see where that came from. Okay, it's just that plus that. Let's say I don't want to double click. I can go to trace precedents. Okay, that plus that, remove arrows. Okay, good. Less debt. We don't have any debt, right? Then we get the target value. Okay, it's just that. Those two together, that minus that. Okay, and obviously if we had debt, you don't get benefit for having debt. You have to deduct it, right? And the shares is just pulled off the income statement, right? This is just an example. And then we get the target price. Okay, and the target share price is just the market value or market cap, the target value, I should say, divided by number of shares. Double click. There it is there. Great. Okay, so we got the price per our target price per share is $33, right? I'm going to go here for a second. Don't look at anything. So the stock price today is $30, right? And you can look down here, okay, 33, right? But watch this. If I actually open this up a bit, we can see it's 32.77, okay? That's fine. Let's go back here, okay? And if I make that a little bit bigger, it's 32.77. That's fine. Let's just keep it simplistic, okay? Okay, great. Chris, what's going on down here? Well, I've got an extra step added. It's called sensitivity analysis, okay? And what this means is this, investors love this stuff, so do portfolio managers. So if you double click, you'll see, oh my God, Chris, I'm so confused. What are you doing? All right, so hit escape. Don't double click it then. So this is the same as here, okay? And that's assuming, and this is our base case, okay? 11.5% WACC, right? We should just pull from above, okay? And we're using a 2% growth rate, okay? Great. So what if we assumed that the growth rate's going to be 3%, okay? And our WACC is still 11.5%. Well, our target price should be 36 bucks there, okay? Okay. What if we assumed that our WACC, our cost of capital, is only 5.5%? You can play around with these if you want, okay? So all I did here is I just deducted 3 from each one, then added 3 here. And you could play around these too if you wanted to. If I want to make this 25%, right, then, if our cost of capital is that high, then this is a screaming short, right? The target price would be that. Okay. Control Z to undo that. If we're extraordinarily bullish and we have a WACC of only 5.5% and a growth rate of 3%, that's our target price, right? Bullish is green, base case is orange, red is bearish, okay? And that's why I started off this whole course talking about the macro. Because if you get the macro wrong, your micro doesn't matter, okay? So if you're really bearish on the economy and there's a 2008 type crisis year, which God willing will never happen again in our lifetime, then you would have a much lower target stock price. Okay, and so that is it for discounted cash flow. I hope you enjoyed it. I hope you play around with this too, please, and see what happens when you increase or decrease the beta. Actually, let's do that. Let's make the beta 2 for fun. Okay, watch what happens to our target price down here. It's 33 now. If we make beta 2, our target price is 25 bucks, right? Now, if we made beta 1 in line with the market, our target price is 48. Okay, so again, there's lots of independent variables when it comes to discounted cash flow analysis, or DCF as they call it, which is not why I'm not a huge fan, but value investors love this, and it's my job to give you a menu of all options. Okay, now you understand DCF, and in step 7, we're going to discuss 2 other valuation methodologies, which is PE, which is my favorite, and price to revenue. And at the end of step 7, you just take an average of all 3. Okay, and that's our blended average target price. Okay, we're done.